Gentlemen, thank you so much for joining me for today's masterclass. Now, first and foremost, I think it's very important to define small caps. Can you give me your definition of small caps?
ClearBridge, we tend to stay below $3.5 billion on purchase, and then keep the overall portfolio in line with the Russell 2000.
And when we're talking about small cap investing, I think it's very helpful to get your individual approaches before we get into this masterclass. So could you give us your approach when it comes to this type of investing?
Well, for ClearBridge Small Cap, what we try to do is create a variant perception that we have, whatever the company may be. If there's a reason why we think it should be valued differently from how the market is valuing it, that's our key. So we start with the expectations in the market price. What return on capital, what investment rate, what growth rate is necessary for it to be worth what it's trading for right now, and then see if we have a reason to believe that one of those factors should be better than the market expects. Whatever kind of company it is, we'll buy it in that case, and as that discount closes, we readjust and find something else.
Brian, can you tell me about the current market expectations and how the differing perceptions create opportunity, especially in the small cap space?
Yeah, well, as Jay was saying, there's a lot of herding behavior in the market right now. When there's a tweet about trade going well, there's a whole set of stocks that does well. When there's a tweet about it going badly, that whole set of stocks does poorly. Growth has been a concern for some time, so growth is at a great premium right now. And it's getting to the point where a fund like ours, who is more or less indifferent between value and growth styles, we used to source a lot of our best ideas from growth buckets, companies that the market just wasn't appreciating how strong their competitive position was. Now the market is over-appreciating the strength of competitive positions in a lot more cases. We found ourselves underweight information technology now for the first time in a decade, probably, because the multiples there have just become unsustainable. Where we're getting a lot more ideas is where babies are getting thrown out with bathwater. People want to move away from levered companies, and so all levered companies are going down, but there are some in there that the leverage is less onerous. They have asset-backed liabilities that they can shed. They can trade assets for their debt. One way or another, they're not going to be as liquidity trapped as somebody whose whose debt was based on their future cash flows. So we can take a company and have a variant perception that this leverage is not as bad as that leverage, even though they all went down the same way together. So it's a bad way to live in the market because it feels like you're just getting whipsawed back and forth, but it's going to be good in the long run for stock picking.
Mm-hmm. And gentlemen, both of you mentioned time horizon, and I think that is very important when it comes to the small cap space. So for viewers out there who are curious about what you mean when you say long term, what is your definition?
Well, I mean, we value the companies on a long-term basis. Mm-hmm. So we're thinking about what their value is going to be with a long competitive advantage period and then a residual value. Whether we hold them long-term or not depends just on how long they stay undervalued. But when we say long-term time horizon, that's what we mean. What is the company going to be worth over its period of existence?
Now, Brian, are small cap companies generally less affected by some of the global trade conditions and more domestically driven, would you say, than other stocks such as large caps or even mid caps?
I think there's a perception out there that is true. And so again, when you have trade noise come up, small caps may suffer more in that environment. I think the global economy is now so complex, so intermingled, that to understand the direct and indirect effect on an individual company of trade tensions is very difficult. You might be a small cap supplier of nails, but you get your steel from Canada, and when the tariff goes on steel from Canada, you're out your supplier. In many ways, large caps have more flexibility because they probably have more complex supply chains that they can move around, move manufacturing from one country to another. So it's a perception. I don't think it's true. I do think that everybody benefits from a economy that's working well, and everybody's hurt by an economy that's working poorly.
What are you seeing when it comes to the current growth and value spread in the market?
Yeah, exactly. We see much the same thing. There are some sectors, materials, energy, where you can find good companies in the midst of ones that do have bigger problems. companies that are earning good returns on capital and they're paying dividends, and you can buy them at really good prices right now. On the growth side, it's significantly harder to find areas where anything that's growing is meaningfully undervalued because there's been such a thirst for growth from investors in the market. But there still are some candidates out there, especially in again, kind of areas that otherwise are not as sexy. You can have an energy company that has a really good product and is growing and is getting tossed away with other services companies in a way that is inappropriate. So again, we want to look at the company, and our job is to say, how is this company standing out from what the market thinks of it right now? It's a little bit like horse race handicapping. It's not about whether you think the horse is going to win. It's about what are the odds on the tote board, and do I have an advantage when I choose that horse at these odds? We can find long shots that come at good odds, and we can find favorites that come at good odds.
Mm-hmm. And for those in the viewing audience who may not be quite so familiar with the relationship of interest rates and the small cap asset class, what would you say to them, and how would you say that rates have affected the small cap space through different economic cycles?
It's been a phenomenon throughout the market for the last few years. The cost of capital is low, and so biotech companies in the public have been able to get good funding at preclinical phase 1 kind of moments in their life, which is very early to be getting public capital. And in the private market, it also has been able to get funded extremely early, and that again is also a result of the cost of capital being so low. That's problematic in that area of the market. Elsewhere in the market, though, I think one of the ways in which small caps is in some way superior to large caps is while there's more volatility in individual companies, there is more diversification. So when you're buying the S&P 500 at this moment, you are buying a big chunk of 10 companies and then a bunch of other smaller positions. When you buy the Russell 2000, you're getting a lot of very small positions. So you're diversifying a lot more than if you're going the S&P. Basically, you're buying Facebook, Netflix, Amazon, Google, Apple, Microsoft, and some others. So that's what I really like about small caps, that I have all kinds of different pools to fish from. I don't have to have an opinion about Facebook at this moment.
And Brian, before I move away from you, I want to ask you a question about shareholder value. Do you think companies are rethinking the meaning of this right now?
Yeah, the Business Roundtable put out a paper recently, and it generated a lot of headlines that said something like, CEOs have decided that shareholder value isn't working anymore. And that was ludicrous. I mean, what they were saying was a very politically savvy way of expressing that we're not only about shareholders, we're also about customers, making sure they're satisfied, employees are satisfied, we don't hurt the environment, we do good for society. When Al Rappaport wrote about creating shareholder value in the 1980s, he noted all that. He said, in order to create shareholder value, you need to have a sustainable company over a long period of time. To do that, you can't have big environmental liabilities at your feet. You can't mistreat your employees, they'll leave. You can't mess with your customers, they will not buy your product after the first time. So they're saying they're going to invest in their employees and they're going to not pollute the environment. Great. That's what they should have been doing before, and most of them who were thinking truly about creating shareholder value were doing that.
And I think each and every one of you have highlighted some of the misconceptions as well as myths surrounding small caps. And since we've already jumped in, do you want to highlight any other myths out there that really get to you when it comes to small caps?
As I said, I think people don't realize the degree to which you're really buying one sector and very few companies when you're buying a large cap index portfolio, when you're buying the S&P 500. And to think that it's less risky to invest in 2,000 different companies than it is to have 20% of your money in 20 different companies. I just think that's misplaced.
And do you want to weigh in on this as well in terms of sectors where you're seeing opportunities?
Sure. Mine is a core fund, so we're trying to source opportunities across the market at all times. I could tell you where we find a little bit easier and harder. A year and a half ago, we were finding regional banks sort of a place that's very difficult to find stocks that were really attractive. They were mostly trading at very high multiples of book. The loan growth was good, but there's no provisions in the earnings, and so in some ways their PEs are being overstated right now relative to a normalized credit cycle. But credit's been excellent. So it was difficult to find something where I could say I have a real variant opportunity on this stock. Fast forward to now, banks are much less popular, rates are coming down, yield curve is inverted, and net interest margins are compressed. And credit is still good, but everybody's waiting for the credit shoe to drop. And that is a place where when we've seen a couple credit shoes drop, even though they weren't significant parts of the portfolio, so it wasn't like losses were enormous, they were more like a little bit more like average. These companies were being sold down to tangible book value, and even though they have mid double digit, mid-teens ROEs, returns on equity. So that's been a place where we've really found some great ideas in the last year or so. Metals, materials, other kinds of things that have been subject to trade issues, retailing and apparel. Those are other areas where we're finding very good companies that are trading at either low multiples, often below replacement value, sometimes at a quarter of their book value, their tangible book value. So those are very attractive, but we do need to kind of keep a lid on how much we want to do in that kind of thing, because we don't want to skew our portfolio too much so that if there really is a bad recession, we suffer. Valuation is not a very good protector on the downside in a recession, so we want to have earnings quality in there with that. We always measure our portfolio against our benchmark in terms of those factors. So on the earnings quality side, we're able to find good companies that are reasonable in areas like tech, in semiconductors, but it is much more challenging now than it was. We used to be very pleased with our software holdings, and now it's really, really hard to find something in software that's interesting. So that's the area where we think that eventually we're going to get a reversion, and those valuations are going to come back down to something more reasonable, and we'll get benefit from that because we'll outperform the benchmark on that point, and we'll get a benefit from outperforming in the more leveraged, more hard good areas of the market that rebound.
When it comes to the big R word, what are your thoughts?
I mean, my fund at ClearBridge Small Cap, we try not to even guess at what the future is going to bring. That's not our forte, that's not our expertise. We can't do that consistently well over the long term, and we don't really think anybody else can. So it's all about the odds, again. So to Jay's point, the pricing is showing very, very high odds of a recession. I am willing to take the other side of that. Now, if that's a 60% chance in the next year versus an 80% chance, okay, that's still a big chance of a recession. It could happen. But the certainty with which stocks have been reacting to news flow, the certainty with which people take a tweet about the trade deal being solved or never being solved, you can't act with certainty in this market, and when someone else is going to be willing to put money down with certainty, I'm usually willing to bet against that.
Expectations for growth companies in general have become very high. So tell me about the opportunities to outperform.
Yeah, I mean, we're finding ways in which we can outperform by not buying ridiculous valuations. Unfortunately, one of the detriments of working with the Russell 2000 is a company can do extremely well, and everybody can be very excited about it. June comes, and the Russell rebalances, and it goes out of our index, and then we don't benefit when it falls apart the next year. That's always difficult to see. But because the valuations are so broadly high in some areas, we think that we're going to be able to benefit from not being in areas that are overpriced. We also think that there are a lot of growth areas where patience is just really, really short. Biotech is not an area that we're regularly underweight because of our inability to forecast, whether something's going to be successful. Then the payers are going to cover it. Then it's going to get reimbursed by Medicare. Then people are actually going to prescribe it. But there are drugs that once they hit the market, they have a little trouble with getting that payer coverage and getting the doctors to recognize it fully. But it's a good drug, an effective drug for a population that needs the help. That's a growth opportunity that a lot of times biotech investors are throwing out saying, I'd rather invest in a sexy, cancer curing drug rather than a glaucoma drug. But glaucoma is a serious problem for millions of people, and they will be willing to take this drug once it gets all the coverage. So we can find a number of things like that in healthcare, even when valuations generally are very high.
Can you tell me a little bit more about why an active, multifaceted approach to analyzing profitability as well as stability is so important across industries?
Yeah, I think the asset class definitely needs to be part of client portfolios. Large caps don't offer significant diversification. You really need to have the extra diversification of small caps, I think, to provide a balanced portfolio to your clients. They need to be aware of the large cap concentration. That is a major issue for anybody who's buying large cap stocks right now. If you're a passive investor, that's definitely true. You're definitely buying big portions of individual companies in large cap. It's better at small cap, but to Jay's point, that index includes about a third companies that don't make any money. And more have been coming out every day. My inbox is filled with IPOs every Monday these days. And they are not all solid gold, let me tell you. So you're buying a lot of things that are out there now because the capital is available now. And when the tide goes out, we're going to see who's wearing swim trunks, and a lot of those companies are not. And you're going to wish, I think, that you had an active manager who was more discerning in how they were choosing their stocks than the index.
And gentlemen, we've been able to cover a lot of ground in this masterclass discussion, but we can't deny the fact that we're in the final quarter of 2019. And if we think about the way that Q4 2018 turned out, that was clearly unexpected. So that does reiterate the fact that we don't have a crystal ball. So as we wrap up the quarter and head into 2020, there's a lot on the horizon, including, of course, the US presidential election. But staying away from that, what is your overall outlook as we close out 2019?
I got to tell you, Remy, I loved the fourth quarter of 2018. I loved that, and I loved the early first quarter of 2016 when we had a huge drawdown. Because to Bill's point, and I think it's generally true of active management in small caps, downside protection is our forte. So we outperform in that downturn, and we're finally getting a good look at some stocks that we've wanted to own or even have owned in the past, but just got to be horribly expensive, and we're able to pick them up at much more reasonable prices. I think the market is due for that in a bigger way than even those two drawdowns, and I know it doesn't sound good, but I'm really excited for that for it to happen because I love those periods. That is a time when investors are not distinguishing between quality and poor quality. They're just throwing everything out, and it's a wonderful. It's like getting chum thrown to us sharks. It's like, oh, it's chum time.